Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and taking, of course, to make it actionable, understandable, and clear. What a week! And therefore, what a show. I regret to inform the listener the children are back in school. All good things must come to an end. And so I record in solitude with the dachshund at my side. But you'll have to make do. We've got an excellent show. Some Peter Mallouk data on the danger of waiting for a correction. This is coming up more and more with clients. Market looks a little toppy. Do we just wait on this thing, hang out in cash, see what happens? We'll also look into a Goldman Sachs play where they talk about something called boomer candy. I'd never heard of this phrase before, but Ben Glickman at the Wall Street Journal talks about boomer candy. We then talk about military bases. This was a fascinating one. Stock bets and crypto culture at the military. A lot of investment psychology stuff. And then if we have time, our beloved Harvard University, Texas A&M in the Northeast, has a big wager on Bitcoin. And we will see exactly what they did and what we can learn from it. But at the top, Mr. Peter Mallouk, President and CEO at Creative Planning. He's one of my favorite thought leaders in the investment space. I don't agree with everything he says, but most of what he says, and he puts forth excellent data. Check this out. Including dividends, the S&P 500, those are the 500 companies representative of the American economy, that index, the S&P 500 has gained over 1,200% since the March 2009 low, despite 31 corrections over 5%. Does that make sense, listener? You're going to want to bring in the rest of the family on this one. The S&P 500, and for the really young listener, this is going to be tough to understand, but there was something called a credit contagion crash in 2009 based on these mortgages and banks lending practices and the rest. From that low, include dividends, 1,200% with the fuddy-duddy index fund. However, everybody acts like this is so easy. 31 corrections of over 5%. And then the great quote by Mr. Peter Lynch, the luminary investor at Fidelity who ran the Magellan Fund. Active stock pair, we can still learn. All truth is God's truth. He says this: far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. And this is, I am reminded, I had forgotten some of this. They list out, these 31, they list them all out, but some of them were pretty big. I forgot this one. Did you know in 2010, from April 26 to July 1, 2010, the market went down 17% because of Europe's debt crisis, a flash crash, and growth concerns? I forgot that. I was alive. I was investing 2010. Check this one out. In 2011, the market went down 21.6% from May 2nd to October 4th. So 2011, May 2nd to October 4th. May, June, July, August, September, October. That ain't a short period, folks. I bet that knocked a lot of people off the bull. Down 21%, and it didn't happen in a day. Everyone acts like, it'll just happen in a day and it'll bounce back. No, you had to grind out 6 months or so of just down, down, down. And why? Europe's debt crisis. I remember this one. Get ready. Double dip recession fears. That was a big deal. Here we go. We're back to, I heard a lot of people say, here's this dead cat bounce, Robert. A lot of smart people, a lot of wealthy people told me it's a dead cat bounce, Robert. Buckle up. And then the U.S. debt downgrade, which I know we've probably numbed out to. I know I have. But back then, the U.S. debt downgrade was a sacrosanct, the end of the era. Those were big ones. And there are other ones. It's 10% again in 2012 from Europe's debt crisis. That was over a period of 2 or 3 months. And 2015, 2016, you're down 15%. 2018, I forgot this. 2018, you're down 20%. From September 21 to December 26, you're down 20%. Rising rates, China slowdown, trade war, tariffs, housing slowdown, 2018. That's 2018. 2022 down 27.5%. Now, 2020, we were down 35% from February to March. That was a quick one, COVID. But just when you think about this, it's always been bad. And I skipped most of them, right? Remember, there are 31. I could have read them all. It would have taken the whole show. You would have remembered some, but guess what? You would have forgotten most. I had forgotten most. If you gave me a blank spreadsheet and you told me, Robert, there were 31 corrections since March of 2009. I want you to write in each date of the correction, the duration of the correction, and the decline on a percentage basis, as well as the reason why it fell. I could get 3, maybe. I could do COVID. I would botch the decline. And I think I would have guessed something in 2012. I remember something going on in 20, but I would have, maybe would have gotten 1. That's embarrassing, guys. I'm ashamed. You're listening to my podcast, and in 2022, I forgot this one. Did y'all know in 2022, from January 4th to October 13th, it was down 27.5%? That's 2022. Inflation, rising rates, Fed tightening, Russia, Ukraine war, recession fear. Guys, I forgot that. This is tough to believe too in 2025. Y'all remember that? February 19th to April 7th, down 21%. I'm losing my mind. I can't keep up with all the corrections. So the lesson to me is good luck anticipating them. I can't even remember what happened when they did happen. What chance do I have anticipating them? So, you know me, that time horizon staying long because I have to. I can't keep up with anything more than a long time horizon and just taking the hits. Head on to the Wall Street Journal article. Goldman makes a $2 billion bet on Boomer Candy. I don't love the name Boomer Candy, and I'm not sure how respectful it is to that generation, but they call it that. Bank to buy Innovator Capital Management, which specializes in ETFs that protect investors from downside. So I see this. I get an advertisement for this about once a quarter. Sometimes there are these mass mailers to registered investment advisors, which is what I am, and they say, hey, Robert, you need to give this to your clients because, and you just heard the first data, all these corrections, these 31 corrections since 2009. Don't you want to smooth out the ride? Yada, yada, yada. Well, wouldn't you know, there's a product for everything, and fear and greed runs the market, so they're playing on your fears, maybe some greed too. But what they say is baby boomers and people close to retirement, the article explains, have flocked to funds as a way to stay invested in the market, even while trying to remain conservative. So the nickname of these, they call them buffer funds, is Boomer Candy, because they want to try to keep, you don't take the downside, but you get some of the upside. So they're going to limit your upside, but limit your downside, and they're going to package it and put it in a product, and there you go. So Goldman Sachs is, putting their tentacles out there and probably shrewdly buying a venture capital firm called Industry Ventures. And they're going to buy into T. Rowe Price, and they're going to start pitching these buffer funds. And they're a big old broader category of the exchange traded funds. Another way to call them is defined outcome funds. Now, I agree with the end of this article because anything that sounds too good to be true, it probably is. And I've looked at these buffer funds, or they call them Boomer Candy funds, where sometimes they're using options and they're trying to, make bets that the market will fall down, so those options will pay out to keep you flat. That gives you that market downturn protection. What are they doing? They're just making here's the end of the article. Thank you, Ben Glickman. He says this: defined outcome funds have drawn criticism from some in the investing world, I'm one of them, who have argued that the ETFs don't offer the same diversification as traditional bonds, and deliver lackluster upside, It's just, they usually just ensure higher fees and I think usually confusion. What did I buy here? Does this offer me downside protection? And oh, by the way, beware of those options contracts. Let's hope they were sized correctly. If the market drops too much, maybe they were, maybe they won't. I don't like it. If you want bonds, buy bonds. Part of this, I think, is people's aversion to bonds. I understand why, so hate bonds that they don't want to have any sort of, in retirement, have any sort of protection. I disagree. And then in a fascinating article on financial psychology, Wall Street Journal article, Conrad Putzier says this, headline, Top Gun Traders, Stock Bets and Crypto Culture Take Over the Military. Subheadline, Camaraderie, Competition, and a Strong Bull Market Help Troops Accrue New Wealth. I was trying to punch my ticket. That's the quote here. I was trying to punch my ticket. This is a long article. Sometimes the Wall Street Journal comes out with one of these and it's like, wow, journalism is back. I mean, this is 6 pages or something on a 8.5 by 11, but some fascinating takeaways. What's happening here is And it's actually pretty cool. There's a lot of good in this. I don't imagine this was happening 20 years ago, 30 years ago, but folks who are actively out there flying missions are getting hazard pay, away from home pay. They're just making extra money. And on these bases, people are more comfortable communicating about it. The article explains that everybody kind of knows what everybody's making, so it creates a culture of transparency around finances that doesn't exist in other places. And people talk, and there's some downtime after mission. So the good is people are talking about investing. I think it's one of the best way to learn. If you're thinking, how do I let my kid learn about investing? He's not going to want to do fuddy-duddy index funds. For sure he won't. I'm actually quite all right. Hey, if they have some money, a couple $100 in a brokerage account and want to just go for it, knock yourself out. Buy. Research some individual stocks. And this is a bunch of crypto as well, but these military guys, they're just going hog wild on risk. Their personalities, many of them are more braggadocio, it says. And there's a culture of braggadocio, this Mr. O'Neill says. So folks are wanting to push it and tell their friends, hey, I went all in. But what I found most fascinating is I didn't know they could do this, but they were figuring out who owned crypto in the United States, and they can do it. Uncle Sam can do it by looking at IRS tax returns for those that actually disclosed, hey, the holdings in crypto. I forget what year the IRS required that, but certainly it was around that time. And what they found was there was a much larger percentage at these Air Force bases holding crypto than the broader population. So around Holloman Air Force Base in New Mexico, 16.3% of individual IRS tax returns reported receiving, selling, exchanging, or disposing crypto. 16%. It was higher at Luke Air Force Base in Arizona, 19%, 19.4%. Vandenberg Air Force Base in California, 18%. That's almost 1 in 5 of these people are owning crypto. Across the U.S., just 4% of returns tick the same box. 4.1% of returns tick the same box. They're talking. And the lesson here, let's just get our minds past crypto. Everyone wants to talk about crypto. The lesson here is what informs our investing philosophy is oftentimes those around us. What are our peers saying? What are our friends saying? These military bases put this on a billboard for us with crypto. And this article explains it. A couple folks really did well in crypto, like bought new cars, drove around the base. People asked you why, and you said crypto. And I bet it doesn't take too many people like that before not everybody, 1 in 5 people start buying crypto. The other dynamic that's occurring now is the smartphone and easy access to purchasing stocks and crypto. So 20, 30 years ago on a base or anywhere else, not only maybe there wasn't extra money around, but what were you going to do? So now it's available. So tons of dangers. This article explains it, and it lists some of the failures that a bunch of people would get in on these meme stocks and lost everything. There's a story about a guy on the base day trading, and he'd make a bunch of money, lose a bunch of money. I think in the end, the vast majority will lose money. But like any curve, any distribution, there will be people at the top end who do really well that convince others to mimic their behavior. The great lesson in that article is you got to go to primary sources. You got to read the classics. Don't let your community dictate how you invest. I've made that mistake. I'll probably continue to be tempted to make that mistake for the rest of my life. I think community is such a powerful thing. I recall being 18 years old. I don't think I've shared this story on the podcast. And a physician in my hometown told another one of his peers about this medical stock that was going to cure cancer. Well, wouldn't you know it? I put like $500 in it from the YMCA referee days, and it went up like 10%, and I sold it because I got scared, which was good, and it went to zero about 18 months later. FDA didn't approve the drug. But the community, apparently this was like going around. All the physicians and a lot of their peers were saying, this is it. This is the one. The doctors like it. The doctors like it. So I'm not any different from these folks on the military base. We all have our own environments that affect us. The lesson here is you got to go to the best. You read Warren Buffett's letters, read Jack Bogle's books, read The Simple Path to Wealth, read the books, read The Greatest Minds, and then let that affect the community. Don't let the community dictate your investing thesis. And that was one of Warren Buffett's secret sauces, is he went up to Omaha and didn't drink the Kool-Aid. He just had his own philosophy of investment, and he worked his field, and he stuck to it. So stick to it. Stick to what you know. And then, it wouldn't be a show without talking a little crypto. I know everybody wants to talk a little crypto. Michael Saylor's been in the news, the CEO of MicroStrategy, and he's been having all sorts of troubles. He admitted that he might have to sell Bitcoin. But that's not what I'm talking about. There's a headline, Harvard. Again, I don't think they're in the college football playoffs, actually, Harvard. Harvard's big wager on Bitcoin came right before the bust. The school reported nearly $500 million in crypto holdings in its last quarterly report. So this is not gee whiz, isn't Harvard silly and aren't I smart? It's just look how hard this is. Harvard has armies of analysts and associates and directors and managing directors with ensuring they get the best. And they buy this ETF, iShares Bitcoin Trust ETF, $500 million. And right after they bought it, dropped more than 20%. So their timing wasn't great. How hard is it to time? It's impossible. All of Harvard's machinations resulted in about as poor a timing as you could invent. Maybe it'll end up being okay for them, and maybe they don't care. They probably don't care. But it just shows how tough this game is and how difficult it is to buy assets that don't produce income, nor do they have the prospect of producing income. So not a good, timely bet. And forget about crypto. Oftentimes crypto is a distractor. Any asset like this, that when you buy it, it can drop precipitously in value, and you don't have adequate confidence in its intrinsic value, what it's truly worth, or it doesn't provide an income stream to you, is going to be very hard to hold on to. So let's watch Harvard. Let's just see. I'm curious, will Harvard's foray be worthwhile? And there's some return data. The endowment, let's see, annualized returns on Harvard's investments have lagged behind some peers over the past decade with an 8.2% return. So they got 8.2% return. They ranked 9 out of 10 of the Ivies. So not great. Not great. And if I were, I'm waiting on my letter. It's probably coming any day now to go speak to the endowment as just a thought leader. Just to have Robert come on in, kind of king for a day. You have carte blanche. Organize us. What would you tell us to do? I'd tell them, keep your cost low, keep your investing simple, and keep your time horizon long, because that is what's going to give you the best shot on your investing journey. Until next week.